Alright, we're going to talk about SVB, okay? You can keep this in the background, just listen as a podcast or whatnot. I'm going to be going through the whole entire summary, what's happening, and in real time, what's actually going on with this whole entire bank collapse. Okay, so Silicon Valley Bank, I'm pretty sure, as everyone probably know, if you've been catching up with the news, you probably know that they have already been shut down. Okay, their UK arm just got acquired by HSBC Banking for £1. Okay, and then in United States right now, the Feds are basically bailing them out, okay? But they're not bailing the SVB people, but they're only bailing out the depositors. Okay, so I'm giving you guys a very, very brief summary of what actually happened to become to what we are actually having today. Right now, the market at the moment, okay, it's the pre-market of Monday. I'm probably gonna upload this quick for you guys, so you can actually see this ASAP. By the way, the market is basically tumbling down, despite the fact that in the futures, they were actually up about 2%, but right now everything is going back down. The reason being, nobody trusts this to continue. We think that this is going to continue rippling through the entire market, causing mass destruction. Right, so first things first. Okay, let's talk about SVB. SVB actually came up with this whole entire plan for them to actually invest back in 2020, buying 10-year bonds, even until 20 and 30-year bonds, with a yield of 1.87%. They were actually averaging about 1.5% per annum for all those bonds. Okay, these are all MBS, which are mortgage-backed securities. A lot of all these bonds are actually pretty useless, simply because for bonds to actually be worth money, you have to wait for the entire maturity of the entire bond for you to actually get the money. So for example, if you have a bond worth $1,000 giving you 2% yield, let's just say this $1,000 bond, you are going to be waiting for 10 years. You're only going to be getting your $1,000 plus your 2% yield at the end of the 10 years. You're not going to be getting it anytime you want. And the thing about bonds is that because they're all going to be traded in the open market. So whenever bonds are actually being oversold, effectively your $1,000 is not going to be worth $1,000. Okay, especially with how the Feds have been raising their rates. They've been going up and up and up. We have been seeing 4%, 5%. Even for right now, we're expecting the Feds to cut off the terminal funds rate to be at about 5.1%, which according to Jerome Powell in the most recent Congress testimony, he actually said that he is going to be increasing the federal funds rate, aka the terminal funds rate as well, which means that we are most likely going to be seeing a revision upwards. So 5.1 was the old number. We are expecting 5.5%. Some people even expecting 6%. Okay, so because of this, we see interest rate continuously going upwards and upwards and upwards. This, however, decays the value of bonds that was actually bought when the yield were very, very low. So the whole entire premise of why SVB actually bought into all these low yielding bonds is also because of the fact that they are in the business of startups. They're in the business of risky companies. They're in the business of all this high risk, high reward sort of investment, and therefore they need to go and look at a smaller portfolio where it is going to be low risk to effectively no risk. Okay, but of course, a lot of banks are actually doing it. It's not just SVB, even your JP Morgan, your Citigroup, Bank of America, Wells Fargo, any one of them, they most likely do have low yielding bonds in their portfolio as well. But it just so happened that SVB were using depositors' money to get into those low yielding bonds. And today, with a rumor just coming out that there would be a bank run, that basically just tip over the iceberg and crash the whole entire thing. Because whenever there is a rumor for a bank run will happen. Okay, just think about it this way. Whenever there is a rumor for, let's say, a new virus, chances are, when there's smoke, there's fire, effectively. So because of that, the whole entire bank run effectively did happen even for Peter Thiel. He was telling all of his those companies that he's working with, all those VCs, venture capitalists, all of them were telling their partners, hey, get your money out of SVB. We heard that there's going to be a bank run, things like that. Everyone just stash money out. We're going to get all our money out as quick as we can. And think about it this way, there's no downside to taking all your money out. There's only upside from that. The only downside, which I don't even consider it as a downside, is that the bank would think, why are you taking out all your money? but there is zero consequences or there's zero penalty for you to take out all the money. For example, today, let's say you have $200,000 in the bank. You taking out your $200,000 from your bank to bring it over to another bank, they cannot really penalize you or anything because those are all liquid cash in your account. Unless, of course, those $200,000 is actually being pledged into some various different investment vehicles that you have actually signed a consent to the bank. If it is completely liquid, you cannot have any penalty for you to actually move those liquid money away from the bank. So the only upside from there on out is that you get to keep 100% of your money. The downside, however, is that you're gonna get completely destroyed because if the bank actually just go to shit, all your money's gone. All your money's gone. Okay, of course, if you're talking about $200,000, technically FDIC do insure you. Let's just say you have $500,000, you're gonna be FDIC insured up to $250,000. Hence, all the rest of the money is all gonna go poof. Okay, so SVB basically imploded, and the Feds came out to say that, even the Feds were working on during the weekend, and they actually had to have a meeting to say, all right, are we going to bail them out or are we not going to bail them out? Janet Yellen actually came to say that they're not going to bail out SVB, which I think makes a lot of sense because if you were to bail out SVB, you're just creating a moral hazard, which was actually talked about back in 2008. When they were talking about how bailing out all these different banks, all these different companies for doing such risky bets, for doing such a bad management for investment, is only going to encourage them to do more bad things in the future. Because if whatever actions that they actually have brings zero consequences, it only promotes them to do it more in the future. A moral hazard, especially for banks. Let's be honest, you're working with other people's money. You're not just working with your own assets. You're not only working with your own money, you're working with all your creditors, you're working with all your customers, your clients, your companies out there. Okay, you're not using your own money, you're using everybody else's money. So, of course, you cannot have a moral hazard happening in the banking industry. So, of course, a lot of people are saying that, it's better for you to actually just withdraw your money out and put it in the top 4 banks, top 8 banks, top 10 banks. But let's be honest here, okay? SVB was the top 15 company, was the top 15 bank in the United States. You cannot really get any safer than that. We're not talking about how you're putting it in a bank that were only managing $100 million worth of assets. You're talking about a company that was managing $205 billion worth of assets. The top 15 bank in the United States. It's very hard for you to actually fight for the argument that, you are not supposed to look for a shoddy bank. You should be looking for JP Morgan. You should be looking for Morgan Stanley, Wells Fargo, Bank of America. That is not the argument here. Because the argument that you're saying that, you should actually choose your bank, okay? And that's why they actually made a mistake, which is why I think it's correct. The depositors should get back their money. Okay, a lot of people are actually arguing on the other side saying that depositors should actually get the brunt of it as well, even though SVB definitely had it coming and they definitely have to pay for whatever that they are actually deserved for. People are actually arguing the fact that depositors should actually pay for it as well. However, I do disagree on this part because I think that depositors are the most innocent one out of all of them. Okay, it's true that the argument often actually brings forth the same argumentative effect, which is that the only reason why they're actually with SVB is because they're actually giving them covenants and telling them that, we're going to give you a loose way of loaning money. We're going to give you a way for you to loan money where you don't have to follow various guidelines. You are kind of going into the gray. You're not going to be going through regulatories because for all those startup companies, you literally have $0 in assets and they're able to borrow up to $100 million. So of course, SVB do give a lot of perks to all these different companies. So there is a sort of a little bit of an argumentative point over there. However, today you're talking about depositors' money. People who actually get the money, I don't care, from their businesses, from their parents, trust fund, I don't care. They got their money and put it into SVB. You need to keep it safe. I think that goes without saying. However, if you're talking about shareholders of SVB, they should not get bailed out at all because you're investing in the bank. You're investing in the bank that failed. You're investing in the bank that you failed to do the due diligence on, and the bank failed. That's kind of on you. But the depositors, on the other hand, they don't have to do the due diligence on the bank for them to put in money because they are a bank that's regulated by the United States. They are the bank that's regulated by the SEC. It is not my responsibility for me to actually know if this bank is going to be liquid for me to put my money in it. You're regulated, for God's sake, you know. So I think that the depositors, I'm glad that the depositors are getting their money back. Chances are they're going to be getting their money back by today. On Monday, they're going to be able to access 100% of their money today. Okay, but of course, SVB is still going to get completely destroyed. I'm glad that HSBC actually bought it for £1, because that way now HSBC is going to be filtering all these clients that's under SVB for the UK arm. However, the Feds, on the other hand, they're actually going through with FDIC, which is the $250,000 per company, which is kind of ridiculous, because companies, especially in Silicon Valley, you're not talking about SMEs over here. You're not talking about small and medium enterprises. You're not talking about companies with just 5 workers. You're talking about companies with effectively 100 workers, 2,000 workers, 5,000 workers, and so on. $250,000 is not even going to complete 1 month of payroll. Okay, so having this kind of insurance is kind of like, why even bother? Just close us down if that's going to be the case. And of course, if you actually watch the All In podcast, which is by Chamath and David Sachs, all of them, they were actually talking about it, and I think it really makes a lot of sense, which is, whatever, if they do not actually get bailed out, all those startups, companies that actually are depositing their money with SVB, if they don't get bailed out, you are going to be torching the innovation of United States. People, all these companies out there, all these startup companies, when they were pitching to all these VCs, they were pitching to help US be a better place. They are helping with climate change. They're helping with cancer research, medication, whatever it is, okay? All these are going to be helping innovation in the United States, or even in the world itself. And by doing this, you are basically just burning off the entire decade. It's going to be a lost decade. We are going to have one whole decade of all this innovation just going into the smokes. And it's just a pity for us to actually see that happening. So yeah, for SVB, that's the current situation. So just yesterday, we actually also got the news that Signature Bank, which is also another big bank, effectively the third biggest bank to collapse following on these deposits. The first one was your Washington Mutual Bank back in 2008. The second one is the SVB, and now the third is Signature Bank. Signature Bank, just like a fun fact sort of thing, Kraken, which is the crypto exchange that I personally use, they actually use Signature Bank. But if I'm not mistaken, about a month or 2 ago, they actually released a statement saying that they are not going to be using Signature Bank anymore. I did not really realize anything when they actually sent that email out. Okay, so today, seeing that Signature Bank actually closed down, chances are the writings was actually on the wall. So who knew? Okay, so Signature Bank just kind of imploded, and right now people are thinking First Republic is most likely going to be imploding, which is why in the pre-market alone, First Republic is down 60%. Okay, and if this doesn't just ring up all the alarm bells or all the red flags in your face, remember SVB dropped 60% in the first day as well. Come on, the writing is on the wall, and this is why a lot of people are worried. If banks like SVB just collapsed, Signature Bank just imploded, okay, your First Republic is going to be coming up next, and all these regional banks are all going to be affected as well. Okay, this might be as catastrophic as what people are actually worried about, and that's kind of the concern over here. And I've been talking about how I've been bearish on the market. However, I've been bearish on the market for different reasons. So today I have to redo my entire thesis over it. So I'm not sure if I'm going to be going through my whole entire thesis in this current video, okay, but I will just kind of give you guys a brief rundown. The reason for my thesis on being bearish is because I think that we're not exactly at the bottom. Inflation has not exactly shown us that it has been fully entrenched, and we have not seen inflation just completely, just smoothen out and even going downwards. All we're going to be having is disinflation. We're not getting deflation anytime soon. And that means that prices will only go up or not go up as fast. But prices will go up. Prices will not go down. And that is a huge issue, because if inflation doesn't go away, we doesn't get deflation, this whole entire market is going to shit. Okay? Which is why I am constantly banging on the fact that, this is horrible. The Feds will have to raise rates. Think about it this way. When the Feds talk about how employment report were being good, okay, good employment report, aka with jobless claims going downwards, less jobless people. Effectively a good news for the market, correct? Nope, not a good news, because when that actually happens, it means that it is actually a bad news for the market, because stocks market is going to go down because your jobless just went down. It simply means that the Feds are going to tighten even more. That's how crazy it is at the moment. Bad news creating good news, and good news creating bad news. And only then, when we have a day when we have good news giving us good results, bad news giving us bad results, that is when I feel that we are most likely going to be going back to normal again. Back to normalcy. I think it's very fair for me to expect normalcy in a normal market, hopefully so, before I actually turn fully bullish again. But of course, I do not want you to misinterpret what I'm saying. I am quite bearish in the market, but I do have bullish position, because ultimately, I'm pretty sure a lot of people are most likely going to be watching this and kind of thinking about it, saying, time in the market is a lot better than timing the market, and I totally understand that. Which is why for my bullish portfolio, which I am seriously thinking, I'm gonna put it for 10 years, I'm gonna put it for 20 years, I don't care. Those bullish portfolio is still there. I'm not selling them all, okay, and going all in on being bearish. I'm just putting in more money that I actually have been earning throughout the months, throughout the years, in these few recent months, and putting it onto bearish bets, because I think that the market is most likely going to be more bearish than I think. Okay, so which is why this is just basically like a play for me. I've been up about like 65% in the past 3 days, and it's kind of insane, because I'm using a very small part of my portfolio, and I can still be up 65%. That's just how crazy the market is. And I think my thesis have to change a little bit, because I was talking about rate hikes. But today, we have to talk about how this actually fundamentally changes my thesis just a little bit. Reason being, with all these banks imploding one after another, this actually brings forth a new concern of some sort, because the Federal Reserve is now going to be thinking, maybe we cannot, just hike up all those rates anymore. I don't think we can do a 50 basis point increment anymore. Why? Because a 50 basis point increment now might destroy the market. We might not even be able to do a 25 basis point increment, because the thing is that if a 25 basis point increment is also going to be quite scary for the market. So maybe it is time to pause on the rates. And when a pause on the rates actually get introduced into the market, I believe my thesis will definitely have to change, because my thesis is that we are most likely going to see another 50 basis point increment in the next coming FOMC. And this kind of changes this whole entire narrative, doesn't it? Which is why I'm kind of worried. I'm not saying that I'm going to just suddenly get out of my bearish bet, because personally, I'm still thinking Federal Reserve increasing or not increasing rates might be a huge part of my thesis. But right now, we have to talk about banks collapsing one after another. I think this is a huge point. So I believe that I might very well have to continue on my bearish bet on the market. So, I don't know about you. Right now, if we're looking at SQQQ, which is a way that I'm actually betting on being bearish on the market at the moment, the SQQQ actually went down in the pre-market from about 41 down over to like about 39, okay? Because the Nasdaq futures went up by 2%. Right now, they're actually going up steadily. Right now, we're at about 41 again. So, chances are, when the market actually do open later on, what can you say? There is a very good chance that we might actually see that the bearish market would actually continue on and on. But of course, besides the whole entire stocks market and bonds market, if you are in any sort of regional banks, get out of those regional banks. I'm not sure if you are going to be a United States citizen watching this video. I'm not sure if you're going to be a Singaporean watching this video. For Singaporean, I'm pretty sure we are kind of safe. Even MAS, which is the Monetary Authority of Singapore, even came up with a Bloomberg article saying that the exposure that Singapore do have with the collapse of Silicon Valley Bank is actually very limited, so we don't really have to worry as much. Which is why even for Singapore, we actually did not see that much of a volatility movement in the markets today. However, despite having limited volatility movement, we still saw the index dropping about 1%, which is still kind of sad for us to actually see that despite the fact that we do not even have that much of a volatility, we were still affected. So if you actually put that into perspective, US banks are definitely going to be getting the full brunt of it later on in the market open. So if you're a United States citizen, if you're watching this video right now, okay, I urge you to move your money over to the top 4 bank, top 8 bank, because they might be the banks that are too big to fail. Okay, you might not like it. You might not like it. But in this level of a bank implosion, I would think it is, you might feel that you are more safer than sorry when it actually comes down to. You do not want to lose 100% of your money in a regional banks, despite the fact that they might give you better interest rates, they might give you better perks, they might give you better benefits, but they might also give you a bankruptcy and lose all your money. So yeah, of course, you can also bet on FDIC to give you the $250,000, up to $250,000 for every failed bank run that actually happened on the run on deposits. Hey, I'm not gonna be a judge on that, but just be careful if you are a United States citizen. But anyway, that's all I have for this whole entire implosion on banks. If you enjoyed this video so far, thank you so much for watching. Just click on the like and also subscribe to my channel. And stay tuned for my next, on Wednesday actually, I'm going to be uploading the whole entire CPI summary because we're going to be getting CPI tomorrow. Anyway, see you guys in the next one. Thank you so much for watching. Bye.